Did you know that your PEA could become your most powerful income machine if you know exactly which ETFs to invest in? Yes, you heard correctly. ETFs aren't just a diversification tool or a simple way to invest in the stock market. When chosen well, they can turn your savings into a real growth engine, year after year, and offer you performances you never imagined. The PEA, or Share Savings Plan, is already one of the tool's most advantageous tax rates to invest in France. With its exemptions on capital gains from 5 years and the possibility of building a diversified portfolio over the long term, it remains the ideal companion for any smart investor. But be careful. Not all ETFs are equal, and not all are eligible for the PEA. You need to know the select methodically to take full advantage of these benefits. Why talk about 2025, 2026, or even 2027? Because the market evolves, trends change, and some sectors that will explode tomorrow are still accessible today for smart investment. The decisions you make now can define your results in 5, 10 years. And this is exactly the strategic time to prepare your portfolio. Whether you are a cautious or ambitious investor, knowing which ETFs to favor and how to integrate them into your PEA can make all the difference. In this video, we will explore together the most promising ETFs for the years to come, those who have the potential to outperform in growth sectors. We will also see how to choose your ETFs according to your profile, whether you are a beginner, intermediate or experienced, and how to avoid the classic mistakes that many investors make by jumping in too quickly. You will finally discover the pitfalls to avoid, fees to watch out for, and tips for building a portfolio that stays strong even when the market becomes volatile. In short, everything you need to turn your PEA into a real growth tool without getting lost in the jungle of hundreds of ETFs available. So, get ready to discover the strategies that will make the difference for your PEA in 2025 and beyond. If you follow these tips, you'll never look at your investments the same way again. And most importantly, you'll be able to invest with confidence, knowing that every choice is thoughtful and aligned with your financial goals. Before diving into choosing the best ETFs for 2025 and beyond, it is essential to understand what is PEA and why it represents an exceptional opportunity for any investor in France. Maybe, or Share Savings Plan, is an account specially designed to encourage investment in European shares while offering very attractive tax benefits. Concretely, as soon as your PEA reaches 5 years, the capital gains that you realize become exempt from income tax, excluding Social Security contributions, which allows your earnings to grow faster over the long term. Plus, you can invest regularly, schedule automatic payments, and build a diversified portfolio without being penalized by taxes, making it an ideal tool for preparing for the future. Now, let's talk about the ETF, or exchange-traded funds. These exchange-traded funds allow you to invest in a basket of stocks or bonds in a single transaction. Rather than buying each stock individually, you can buy an ETF and thus instantly diversify your portfolio. This diversification reduces risk and greatly simplifies the management of your investments. In addition, ETFs are distinguished by their simplicity and their reduced costs compared to traditional funds. While some traditional funds charge several percentage fees each year, ETFs often have annual fees of less than 0.5%, which has a significant impact on your cumulative gains over the long term. However, not all ETFs are eligible for PEA. For an ETF to be placed in this account, it must comply with certain rules, including invest mainly in European stocks. This means that some American, Asian or very specialized ETFs cannot be included in your PEA. It is therefore crucial to filter your choices according to these criteria so as not to end up with an ineligible product and lose the tax advantage. To give you a concrete idea, Here are some popular ETFs in France which meet the PEA criteria. Amundi MSCI, Europe, an ETF that tracks the performance of major European companies, perfect for broad market exposure. Lyxor CIC 40, for those who want to follow the performance of the 40 largest French companies. BNP Paribas, Easy S&P 500. PEA, a PEA-compatible ETF that offers indirect exposure to the US market via compliant structures. Amundi ETF World, for those who want global diversification while remaining eligible for the PEA. It invests mainly in large international companies listed in Europe. In summary, the PEA offers you advantageous taxation, and the ETFs offer you diversification, simplicity, and low fees. Combining the two is a powerful strategy for building a robust and high-performing portfolio over the long term. But never forget,
selecting the right PEA-eligible ETFs is the first crucial step before even thinking about future performance. Choosing the best ETF for your PEA is not a random decision. There are several essential criteria to consider to maximize your chances of long-term success. The first question to ask yourself is, what performance to expect? It's tempting to look only at an ETF's past performance, but be careful, historical performance does not guarantee the future. That said, they can provide a benchmark on the stability and quality of fund management. For example, an ETF that has consistently tracked its index accurately over several years shows that its strategy is reliable and that fees are well controlled. Then you have to look closely at management fees. Even a small percentage of fees can have a huge impact if you invest for the long term. Imagine an ETF with 0.5% annual fees versus one with 1.5%. Over 10 or 15 years, the difference in your cumulative gains can be thousands of euros. ETFs are popular precisely because they offer very competitive fees compared to traditional funds, but you have to remain vigilant and compare the options before deciding. Another often overlooked criterion is the size and liquidity of the ETF. The size of the fund influences its ability to absorb large volumes of purchases or sales without causing significant price fluctuations. Liquidity, on the other hand, ensures that you will be able to buy or sell your shares quickly and at market price without incurring high spreads. An ETF with low trading volume may look attractive on paper, but it may be difficult to sell when you need it. Then comes the question of the replication, physical or synthetic. ETFs at physical replication actually buy the stocks that make up the index they track. This provides full transparency and reduces some risk, but can be slightly more expensive. ETF synthetic replication, for their part, use derivatives to replicate the performance of the index. They are often cheaper and can offer access to hard-to-reach markets, but present a counterparty risk. If the financial partner providing the performance fails, the ETF may suffer losses. To illustrate this, let's take a few examples. Amundi MSCI Europe, physical replication, very low fees, high volume, perfect for a cautious investor. Lyxor MSCI World, synthetic replication, very broad global diversification, slightly lower fees, but beware of counterparty risk. BNP Paribas, Easy S&P 500, PEA, physical replication suitable for PEA, good liquidity and stable history, ideal for exposing your portfolio to the American market indirectly. In summary, don't be seduced by past gains or the ETF name alone. Analyze past performance and consistency with the index, management fees and their long-term impact, size and liquidity to avoid hidden costs when reselling, the type of replication and the associated risk. By combining these criteria, you will be able to select solid, stable ETFs suited to your profile, maximizing your chances of success in 2025 and beyond. These principles will serve as a basis for building a thoughtful portfolio capable of weathering market fluctuations and taking full advantage of the PEA's advantageous tax structure. If you want to target the best-performing ETFs for 2025 and beyond, it is essential to look promising sectors and themes. Not all ETFs are equal, and certain sectors today offer unique opportunities linked to major economic, technological, and social trends. First of all, the technology remains a key pillar. Innovations in cloud, cybersecurity, semiconductors, and digital services continue to transform the world. Tech-focused ETFs, such as those tracking the Nasdaq or European tech indices, allow you to invest in these giants and growing companies. While the sector can be volatile, its long-term trajectory remains very promising, especially with the exponential demand for digital and connected services. Then the green energy and energy transition are at the heart of government policies and international commitments. ETFs focused on renewable energy, electric vehicles, or clean technologies benefit from a dual engine. Green economic growth and favorable regulation. Analysts predict that investments in solar, wind, and hydrogen could multiply in the coming years, creating opportunities for those who position themselves early. Artificial intelligence, AI, is another sector to watch closely. Whether in industrial automation, healthcare, transportation, or financial services, AI is transforming every sector. ETFs dedicated to AI or emerging technologies offer exposure to this global trend with high growth potential, but beware. Volatility can be significant, and you need to know how to stay calm during fluctuations. The sector of the health and biotechnology also remains strategic. With an aging population, demand for medical care, innovative medicines, and diagnostic technologies is only increasing. Healthcare ETFs often combine relative safety with growth potential, especially if you choose diversified funds that cover several European or global countries. But investing in growth sectors does not mean put all one's eggs in one basket. Diversification is key. Combining multiple sector ETFs helps limit risk while still capitalizing on trends. For example, a portfolio that mixes technology, green energy, healthcare, and AI offers a balance of innovation, stability, and growth. Even if one sector experiences a temporary slowdown, others can compensate and stabilize your overall performance. To make this concrete, imagine a narrative graph. Over 10 years, the tech sector could grow by plus 12% per year, green energy by plus 15%, AI by plus 18%, and healthcare by plus 10%. While these numbers vary, they give an order of magnitude of opportunities and allow you to visualize the importance of spreading your investment between several themes. In summary, identify growth sectors and macroeconomic trends is essential for choosing your ETFs for 2025 and beyond. But the secret remains diversification. Investing intelligently, balancing growth and security, will allow you to take full advantage of opportunities while limiting the risks associated with fluctuations in a single sector. Your PEA will then become a powerful tool for capturing the growth of European and global markets. To build a successful PEA for 2025 and beyond, it is crucial to know which ETFs to watch and why. Rather than jumping in at random, let's focus on solid, diversified options that are suitable for the PEA. Here are 7 particularly promising ETFs with their type, sector, and key advantages. Amundi MSCI Europe. Physique, large cap Europe. Sector, European multi-sectoral. Key advantage, diversification across large European companies, reliable physical replication, low fees. Why promising? It allows you to benefit from European economic growth while limiting the risk linked to a single company or a single sector. Lixor MSCI World, Synthetic World Sector, Global Multi-Sector. Key advantage, global exposure to large caps, maximum diversification. Why promising? Ideal for capturing global trends and profiting from global leaders in tech, health, and consumer markets. Caution, synthetic replication equal sign counterparty risk. BNP Paribas, Easy S&P 500, PEA, Physical, United States. Sector, large cap USA. Key advantage, indirect exposure to the American market while remaining eligible for the PEA. Why promising? The US market remains the engine of global innovation, and this ETF combines performance and advantageous taxation. Amundi MSCI Emerging Markets, Physical Emerging Markets. Sector, Emerging Markets, Asia, Latin America, Africa. Key advantage, growth potential above the world average. Why promising? Emerging economies are growing strongly, and a small percentage in the portfolio can boost overall performance. Lixor, New Energy, ESG, Physics, Green Energy. Sector, Renewable Energies, Clean Technologies. Key advantage: exposure to energy transition leaders, sustainable growth trend. Why promising? Demand for green energy is exploding, supported by public policies and consumers. Amundi robotics and AI, physics technology, artificial intelligence. Sector: AI and robotics. Key advantage: exposure to companies that are transforming industry and daily life. Why promising? AI is a disruptive sector with very high growth potential over the coming decade. iShares healthcare innovation, physics, health and biotechnology. Sector: health and biotech. Key advantage: investment in medical and technological innovations in the health sector. Why promising? With an aging population and medical innovations, this sector offers both stability and growth. Practical advice for integrating these ETFs into your PEA. Start beyond or two main ETFs to lay the foundations of your portfolio. Gradually add sector or thematic ETFs according to your profile and risk tolerance. Think about smooth out your purchases with regular payments, DCA strategy, to take advantage of market fluctuations and reduce timing risk. Always keep a balance between defensive sectors, health consumption, and growth sectors, tech, AI, green energy. Risks to keep in mind: volatility. Certain ETFs, particularly sectoral or emerging ones, can fluctuate significantly. Market trends. Past performance does not guarantee future gains. Some sectors may slow down. Counterparty risk for synthetic ETFs. Be vigilant and diversify to limit the impact. In summary, these 7 ETFs offer a combination of stability, growth, and diversification suitable for a PEA for 2025 to 2027. The key is to gradually integrate these funds, monitor your positions, and remain disciplined to take full advantage of advantageous taxation and market dynamics. Investing in a PEA and placing ETFs in it may seem simple, but several common mistakes can significantly reduce your earnings, or even put your wallet in difficulty. The first mistake to avoid is to invest without a strategy or long-term horizon. Many people get started in the stock market by following advice found on the internet or copying friends without thinking about their personal goals. As a result, they panic during market declines and sell at the wrong time. A PEA is a tool designed for long-term, with favorable taxation after 5 years. It is therefore crucial to define your objectives, your risk tolerance, and to remain disciplined in the face of fluctuations. The second common mistake is to choose ETFs solely on the basis of past performance. Yes, it's tempting to follow the fund that's been booming this year or two, but markets are cyclical, and an ETF that has outperformed may underperform tomorrow. You should always analyze the fund's quality, diversification, fees, and consistency with your overall strategy. Another common mistake is to neglect fees or taxes. While ETFs generally have low fees, these can add up over the long term. Additionally, certain transactions, such as frequent withdrawals or arbitrages, can impact your after-tax gains if your PEA has not yet reached the advantageous tax age. It is therefore essential to understand how management fees, spreads, and taxation work before investing. Finally, many investors make the mistake of overweight a single sector or market. Investing all your capital in tech, green energy, or a single country may seem profitable in the short term, but it carries a high risk if that sector takes a nosedive. Diversification remains the golden rule. Spreading your investments across multiple sectors, themes, and geographic areas limits losses and stabilizes overall performance. To avoid these pitfalls, here are some practical advice. Establish a clear strategy. Define your investment horizon, your objectives, and your target allocation. Invest regularly. Using the DCA, dollar cost averaging technique, helps smooth out purchases and reduce stress related to market fluctuations. Diversify intelligently. Combine sector, thematic, and broad index ETFs to balance growth and security. Stay disciplined. Don't let emotions guide your decisions, especially during downturns or periods of volatility. Track your positions without obsession. Monitoring your ETFs regularly is important, but avoid reacting to every daily change. By following these simple rules, you minimize risks, avoid costly mistakes, and maximize the potential of your PEA. Patience, discipline, and strategy remain the keys to transforming your ETFs into a true growth engine for 2025 and beyond. To go further in managing your PEA and get the most out of ETFs, there are advanced strategies which allow you to combine performance, security, and tax optimization. The first key strategy is the regular approach, also called dollar cost averaging, DCA. Rather than investing a large sum at once, it is a matter of spread your purchases over several months or years. This method helps smooth out market fluctuations and reduce the risk of bad timing. For example, investing a fixed amount each month in your selected ETFs ensures you take advantage of downturns to buy at a better price while maintaining regular investment discipline. The international and sectoral diversification is the second cornerstone of an advanced strategy. A portfolio focused on a single country or sector can be very profitable in the short term, but it remains extremely vulnerable to local crises or sector reversals. For 2025 and beyond, it is advisable to combine ETFs on European large caps, emerging markets, technology, healthcare, and green energy. This approach spreads risk and provides balanced exposure to global growth while limiting overall volatility. Another essential point is the regular monitoring, but without panic. Monitoring your portfolio helps you detect imbalances or opportunities, but it is crucial not to react to every daily market fluctuation. ETFs are designed for the long term, and a temporary drop should never trigger an impulsive sale. It's better to review your allocation periodically, every quarter or half year, and adjust only if your strategy or objectives change. To optimize your PEA while limiting risks, here are some practical tips. Annual rebalancing. Adjust your portfolio to return to your target allocation between sectors and regions. Low-cost ETFs. Favor those with low management fees to maximize your gains over the long term. Take advantage of tax benefits. Keep your ETFs for at least 5 years to benefit from the capital gains tax exemption. And avoid impulsive withdrawals. Avoid overconcentration. Do not put more than 20 to 30% of your capital in a single sector or thematic ETF. Anticipating long-term trends, gradually integrate ETFs linked to AI, the energy transition, or health to benefit from macroeconomic movements without taking excessive risks. By combining these strategies, regular investment, intelligent diversification,
Disciplined monitoring, and tax optimization, your PEA becomes a powerful tool to capitalize on the opportunities of the years to come. The idea is simple. Take the time, stay consistent, and invest methodically. It is not the brilliance of a single operation that makes the difference, but the consistency and discipline over the long term. With this approach, your portfolio can weather market turbulence while remaining positioned for the promising trends of 2025 and beyond, maximizing your chances of success and transforming your PEA into a true growth engine. In summary, investing in a PEA and placing the right ETFs in it is not just about following current trends or seeking quick profits. It is above all about rigorous selection, intelligent diversification, and patience. You need to choose your ETFs carefully, analyzing their performance, fees, liquidity, and replication. Then, you need to diversify your portfolio, both sectorally and geographically, to spread risks and take advantage of opportunities across multiple markets. And above all, never forget the importance of horizon long term. The PEA is a tool designed to grow gradually, and the consistency of your investments will be your best ally in the face of market fluctuations. The advanced strategies we covered, regular investing, disciplined monitoring, rebalancing, and tax optimization, are not secrets, but habits that make the difference between an average portfolio and a high-performing portfolio. Every euro invested intelligently, every thoughtful choice, and every decision taken with patience contributes to building a solid financial future. You are not just buying ETF shares, you are laying the foundation for your long-term financial freedom and peace of mind. So it's time to take action. Start now, even if you only have a small amount of capital to invest. Establishing your plan, selecting your ETFs, and defining your diversification strategy will put you on the right track. Your PEA can become your best ally for the years to come. a tool capable of transforming your savings into sustainable growth. And to go even further, don't hesitate to share your experiences and ETF choices. Comment on your favorite ETFs, ask questions, and engage with the community. If you found this video helpful, like it, subscribe and share it with someone who also wants to get the most out of their PEA. Every interaction helps spread this valuable advice and help more investors make informed decisions. Remember, the key to success lies in discipline, strategy, and patience. ETFs are powerful instruments, but it's your consistency and long-term vision that will make all the difference. So take control of your financial future today and let your PEA work for you year after year.